very basic format of IS1. All right. Now, when you look at IS1, quite a bit comes from different standards. The first thing you need to know about IS1 is the standard only covers the skeleton outline. See, the word is presentation. Presentation means they only cover the outline. Yeah, the skeleton outline. So I tell the students, this is like a bone, the skeleton. All other standards is like the flesh. That means to understand every item here, for example, revenue is governed by IFRS 15. Okay. Then you see this what finance cost governed by IS 23, 28, IS 12, IFRS 5. So today, don't panic when I mention standards. IS1 only gives you a skeleton outline of what is the format of SOPL, SOFP, SOCE. So I did this last week, and I clearly mentioned to you all that in the SOPL, this is called the primary statement. Basically, rebuttable presumption. Rebuttable presumption is all income and expense goes here. Now, Menon, what type of income and expense goes here? We take a balance sheet approach. I told you this. That means when asset goes up, it's an income here. Asset goes down, it's an expense here. Vice versa for liabilities. Liability goes up, expense goes down, good for me, income. So that's the rebuttable presumption. But of course, generally, realized gains and losses goes here. Anything to do with trading activities goes here, day-to-day operating activities. But this is not the view taken by the CF. CF clearly says we use a balance sheet approach. That means assets, liability, increase, decrease is what goes into the SOPL, including gain or loss on disposal. That means if I dispose an asset, the gain or loss comes here. So learn this correctly. All these while, SOPL students will think, oh, generally it's trading activity, operating activity. Realize, no, that's not what the CF says. CF says SOPL is a primary statement. What type of income and expense goes here? Basically, all the movements in assets and liabilities, including gain or loss on disposal. That's the rebuttable presumption. So of course, do I expect you to know the format? Yes, I did this last week. So you got revenue, cost, and GP, other income. So I told you clearly there are only two income items. So revenue deals with sale of goods and services in the ordinary course of the business. So you see, when it comes to revenue, it's very vital that the student looks at the nature of the business. For example, if I'm a leasing company, my main business is to rent out motor vehicle. That rental is my revenue. But let's say, no, I'm not a leasing company, man. I'm just a trading company. But I have some assets which I've rented out and I'm earning rental income. That's not part of ordinary activities. That would go under other income. At this point, the student will be thinking, man, what's the big deal? Why should I learn this? Of course, manipulation, Lydia. Every company loves to push up revenue as far as possible. Earnings management. So other income, they purposely go and put here. That means, for example, let us say gain on disposal. I had a plant, I sold it, I got a gain. Many times a case study will say the finance director asks you to put the gain on disposal of PP inside revenue, but you know that's wrong. It should go under other income. So you see, any standard you learn, the implication of learning that is, if I don't learn it correctly and my superior asks me to do certain things, I might end up manipulating financial statements which could mislead the primary user. So that's the purpose of learning all this. Now the next thing, expenses. You all know. What are the different types of expenses? Cost of sale to do with manufacturing, distribution, warehouse, admin, office, and other expenses. Again, what is other expenses? Anything that is not manufacturing, not distribution, not admin, can go under other expenses, miscellaneous. So for example, my company operates from a head office. Part of the head office is used for all the three. No particular proportion for me to split it. Not faithfully represented. You might want to put it under other expenses, but with appropriate disclosure. The purpose is people who are reading your financial statements must understand what you've done. But then the next item, which is very different, finance cost. You present it net here. Man, why is it presented net? See, in UK, their format is interest receivable, interest payable is shown separately. But for us, finance cost, when we say net, it could be interest receivable, interest payable, because it's a little bit different. It comes because I either took a loan or I have given a loan, which got nothing to do with trading activities, to reflect its function. Yeah, rate is a bit different, so we show it separately. Ignore associates, we come to PBT. So last week I told you, all items here are presented gross, means before tax. So revenue right up to this is profit before tax. Then we have income tax, how to calculate it? IS 12. Then we get profit from continuing operations. But the standard is very clear. Discontinued operation must always be shown as a single line. What is the purpose of doing this? So that when I prepare budgets for the future, I can place my budgets based on continuing operation. If I combine these two together, it would mislead the primary user because part of it will not be in existence in the following year. We're closing down a segment because it was running at a loss. The primary user need to know that in the future, the segment will not be in existence. So yes, discontinued operation must be presented as a separate line. But of course, you could learn it under IFRS 5. Finally, we get profit for the year. Now, I want you to understand very clearly, it is this profit for the year that we use in our EPS calculation. So what's the big deal? When this profit is very low, companies tend to manipulate the financial statement by picking up OCI items and presenting it inside SOPL. Everything in SDR is about manipulation. So this standard clearly differentiates between SOPL items and OCI items. But I told you this last week. Other comprehensive income generally means anything other than what goes to SOPL. But technically speaking, man, how do we know what are the other items? Now, I told you this very clearly last week. Can you please respond? Who is the only authority who has the right to rebuke the presumption? Excellent. That's correct. Very good, dear. So in that, what did I explain last week, dear? Actually got 7 items left, but I'm only showing you 5 right now. 16, 19, 21. I told you remember it as 39, but actually it's IFRS 9 and IFRS 9 itself. So here you got revaluation gain or loss. Can you see PPE? remeasurement gain or loss. Don't panic, you're going to learn everything in the future. Exchange gain or loss, cash flow hedge gain or loss, and IRE gain or loss. Now, in these 5 items, please listen carefully. Now I'm going to continue with where I stopped last week. I need to introduce a new terminology to you. You're free to write whatever I'm writing here. It's up to you. But it's actually the book too. It's up to you. So let's say I tell you, generally, I don't mention what asset lah. Let us say asset. I bought it at a cost of 10. Its fair value is 15. Yeah, at the end of year 1. Year 2, let us say I sold it already for 80, right? I don't mention what asset is this. You hold on. I'll explain what. Now, what I want the student to understand, when what I buy goes up in terms of fair value, the difference of 5 is called fair value gain of 5. But when I dispose an asset, that's called a disposal gain of 3. Don't confuse these two. Very clearly, student must understand there's a difference between fair value gain and disposal gain. Now, disposal gain, this is the one I told you. What's the rebuttable presumption? Disposal gain always goes to SOPL, irrespective of the measurement basis that we use. And what do we mean by that? So whether the asset is at cost, is at revaluation model, is at fair value to profit or loss, is at fair value to OCI, is at ACM, makes no difference. Disposal gain always goes to SOPL. That was the rebuttable presumption I'm talking about. Movements in asset and liability goes into the SOPL, including gain or loss on disposal. So student must be very clear that these models only affects the fair value gain, not the disposal gain. Disposal gain always goes to SOPL. I repeat, disposal gain always goes to SOPL under other income, not under revenue. Of course, that's an area of manipulation. They want to manipulate it so that you will find our case studies with the finance director that you put it under revenue. So you must clearly say no. Revenue is only item that deals with ordinary activity, sale of goods and services from ordinary activity, but disposal of PPE, disposal of IP is not ordinary activity. That must go under other income. I hope you're very clear. Now, focusing on this fair value gain, I'm going to show you 2 examples. You observe what I'm doing. So we're only going to stick to fair value gain. I'm not touching. I'm not worried about the disposal gain anymore. Okay. Now, the first thing, let's assume that this asset is PPE. So that falls within the scope of IAS 16. Right? But if I say no, this asset is IIE, that falls within the scope of IFRS 9. But if I say, look here, this asset is IP, investment property, falls within the scope of IAS 40. Okay? Now, Menon, why is this important, Menon? It's very important because each standard tells us where the fair value gain or loss must go to. Where the fair value gain or loss must go to. So, for example, if I am using cost model, if I use the cost model, you know what happens? We will ignore fair value gain or loss. We will ignore fair value gain or loss. That means even though fair value is going up or down, we don't account for it. We ignore it. But those of you who watch my IAS 40 video, you will notice, because the purpose of buying IP is for capital appreciation, it's only fair that the primary user know about this, and hence the standards say you must at least disclose the fair value, which is not necessary for PPE. Why? Here we use it. Here we rent it out for capital appreciation. Look at the purpose. So you must understand everything that we're conveying to the primary user is based on what we intend to do with it. Likewise, Menon, what if I follow fair value through profit or loss, okay, or fair value through OCI? Here, fair value through profit or loss. Here we say revaluation model, which you would have seen in the video. Can you notice there are differences? These 2 models are the same. But when they say fair value through OCI, different. When they say revaluation model, it's different. So now we need to learn. I've got 2 choices. Every time I teach a standard, I can tell you what is the model repeatedly. Or before I teach you standards, I can teach you all the measurement basis first. Why I do this? You should have finished F7 to be an SBR. That means when I teach SBR syllabus, assumption is you already know all the models. But I don't know where you come from. I mean, like degree or any other basic, maybe you finished degree, maybe you come under any other route, or maybe you've done F7 very long ago. So what I always do in the first class is I teach you all the models first. You must understand how I approach the syllabus. So what Menon would like to do is teach you all the different models. So anytime you learn the standard in the future, you already know the measurement basis much faster. Do you all understand what I'm doing here? Hello? So as I said, when you learn IAS 1, don't panic. You're getting an overview of the syllabus. Why we have to do this is technically you should finish F7 before SBR. I don't know what you remember, what you don't remember. So I will take all the models and I'll teach you one shot. So after this in future, but before I do that, I need to introduce 2 terminologies. Hold on, huh? I need to introduce 2 terminologies called reclassification adjustment and a transfer to RE. I need to explain these 2 things first, a reclassification adjustment and a transfer to RE. So you come to this. Can you look under OCI idea? There are 2 subcategories. I did not do this last week, so I'm continuing now. Under OCI, of course, we know what 7 items. I told you that last week, but we mentioned 5. But Menon, there are 2 subheadings here. item that will not be reclassified to SOPL, items that may be, it's optional, it's not compulsory, may be classified subsequently to the profit or loss. So I need you to understand what is a reclassification and, can you look here, transfer to RE. I need you to understand the difference in this terminology. To be very frank, UK promotes transfer to RE. US promotes reclassification adjustment. And why do we have both? Because when the IASB did a convergence project with UK, that is what happened. When the IASB did a convergence project with US, that's what happens. But of course, IASB has its own reasoning for accepting both. So first, let's ignore the justification behind this. Let's understand first, what is reclassification adjustment, okay? Coming back to this, let me show you. Ignore what asset is it, just leave it. I just want to show you what's reclassification. Let's say I buy an asset at a cost of 10, its fair value is 15, and I've disposed it for 80. So earlier very clearly I told you, that's disposal gain 3. That is a fair value gain of 5. So let's say, whoops, oh yeah, sorry dear, what happened? Sorry, this happens sometimes. Okay, SOPL, SOCI, okay, year 1, year 2, right? So SOPL, OCI. Last week I taught you cumulated in SOCE. You remember last week what did I introduce? Movements in asset and liability goes to SOPL. But OCI, line by line, is cumulated here under a single line called TCR. And what comes here? Owner movements in equity. Remember I said any transaction between owner and entity cannot go here. Must only go to the SOCE. So let's keep that. So year 1, year 2, right? Let's say that's a reserve account and the SOFP, right? Year 1, year 2. Ignore this, huh? Let's see what's a reclassification adjustment. So fair value gain, yeah, this fair value gain. Let's say the standard permits me to take it to OCI. I put it here. Immediately, what must you remember? Open is duplicated, is cumulated in SOCE. SOCE is a cumulative statement. So that gives me 5. So in my balance sheet, asset will appear at 15 fair value. And under equity, I will have reserve 5. Okay, I hope you understand. So this is the whole procedure. Current year goes here. Current year goes here. Cumulated here. Closing balance goes here. I told you this last week. So 5 into OCI, cumulated in a reserve closing balance, which is then taken to SOFP under other component of equity. Okay, but Menon, SOC cumulates. That's correct. So the next year, that becomes the opening balance. In other words, closing balance of year 1 becomes opening balance of year 2. But what did I do? I have sold off the asset. I didn't keep it. I didn't revalue it. I just sold it off for 18. Man, where must the disposal gain go to? Second year, disposal gain goes here directly to SOPL. Okay. So now, in year 2, I disposed already. I have to de-recognize my asset. Don't have this asset anymore. But the problem is, okay, asset is gone. I've made a gain of disposal 3 to the SOPL. But do you all see something hanging here, dear? Do you see something hanging here? Hello? Answer me. What is hanging there? Hey, Manan, asset is gone, Manan, but the reserve is still hanging there. $5. What do we do with this reserve? Is what I'm going to teach you. Listen carefully, huh? So some standards say this reserve of $5 in the SOCE hanging there, asset is gone. I can't leave it there hanging forever. What do I do with this? Some standards will say do reclassification. Some standards will say do a transfer to RE. Don't worry which standards. You just learn the terminology first. Miss, what do you mean by a reclassification adjustment? Reclassification means we will transfer the reserve from the SOCE, that $5, directly to the SOPL. I'm talking about year 2. That means the year in which the asset is disposed. I'll take it out of the SOCE, transfer it directly to my SOPL, of course, through the OCI. You know why, lah? Whatever goes to SOCE must go to OCI. I told you it's a duplicate. So see the implication. That means, come back here. What will happen in the second year? Can you see the $5? You will do a reclassification adjustment. That means remove 5 here, and bring the 5 here. Don't worry about this 5 and this 5. It's just a duplicate only, okay? Technically speaking, what we're doing, we take out of the SOCE, move it into the SOPL. Many people argue against this. Some people argue for it. So let's look at the implication. If I do this, $5 comes into my SOPL in year 2, it pushes up my profit, correct? Not only pushes up the profit, EPS goes down. Think about that. Sorry, not down. EPS goes up, profit goes up, EPS goes up. Some people argue and say, hey, that's not fair. This gain relates to last year. Why is it coming into this year? This is so misleading. It's going to push up my EPS for current year, whereas the profit belongs to the last year. We have double counted it. Last year we put it in SOC. This year we put it into SOPL. Many people argue against reclassification, which is part of your syllabus. You have an ACC article on this. You have to read up. So now, Miss, what is the logic behind it? Why did IASB allow this? Because IASB says right now it's realized already. Okay, it's realized already. It can come into the SOPL. It is available for distribution. And later, tomorrow when I teach you the CF, very unfair, but you will learn what the CF says. You know what the IASB says? I get to decide. So who is the only authority that gets to decide whether it's a reclassification adjustment? Not you, not me. The IASB. See, the irony of it is we call our framework as principle-based framework. But do you realize suddenly, OCI section 7 items, who decides? IASB. Reclassification, who decides? IASB. Don't you think at that point it becomes rule-based? So that is the criticism of our framework, but right now this is how it is. Okay, this is how it is. So reclassification, if I ask you, hey, what is reclassification? Very, very important. On disposal. Don't forget that word. We only do this on disposal. The cumulative gain in SOCE, the reserve, whichever reserve, the cumulative gain is transferred from SOCE to the SOPL through the OCI. So reclassification, I tell my students, remember it like this, one statement to another. We are moving it from one statement to another, means SOCE to SOPL. Lot of arguments for and against. Of course, you have to study. But IASB cut out everything and said, oh, well, we got the authority to decide. And actually, there's a logic behind it. When you learn the CF, you will learn it. But right now, just understand it like this. So, Menon, that's a reclassification adjustment. But what is a transfer to RE? Same story, they are not changing anything. So, year one, $5, accumulate it in reserve, put it in equity in the balance sheet. Year two, disposal gain, $3 to SOPL. All that the same. But what is different when I say transfer to RE? You know what they ask us to do in transfer to RE? So, let us say, for example, this is a IIE reserve. When they say transfer to RE, you know what they're asking us to do? The $5 hanging there, yeah? Don't take it to SOPL. Just move it out from here to this column called RE. Can you see? That means we are just moving from one column to another column within the SOCE. It doesn't go into the SOPL. This sounds more logical. There is no impact to EPS. There's no argument. It just becomes available for distribution. So keeping current year information intact, we are just permitted to move out from this reserve to this reserve. That's happening within the SOCE. That's called a transfer to RE. What are we doing? Close this reserve, move it to RE. See? When I say transfer to RE, come here, you will notice there, transfer to RE. What are we doing? For example, IIE reserve, we simply move it from here to here. That's all. Just add it here, minus here. That's a transfer to RE. Many school of thought by different people argue that this is better than a reclassification adjustment. But IASB says we get to decide which will be reclassified because we have an explanation for it. Miss, what's the explanation? Tomorrow's class in the CF, you will learn. Okay? Menon, why did you teach us this? Come. Now, come to the next page. Okay. All of you come here, right with me here. Okay. OCI has 5 items. Right now 5, later 7, but for now you just learn 5. 16, 19, 21. Actually, this is IS 39, I told you. Write it down, please. Used to be La. Now it's IFRS 9. Look carefully, you will understand. The top 2 digits, that's why I like to call it as 39. I like to call it as 39, although it's IFRS 9. The top 2 digits, 21, 39. Exchange gain or loss, cash flow hedge. These two we are permitted to do a what adjustment? Reclassification adjustment. See, on disposal. Any gain or loss will be transferred from the SOCE to the SOPL through the OCI. And which standards permitted? Just remember the top 2 digits, 21 and 39. But in future, when you learn these 2 standards, yeah, which is okay, when you learn these 2 standards, okay, 16, extreme 2, I call it. The extreme 2. Just remember it like this. You have to, like, you have no choice. You must know which standard permits transfer to RE, which standard permits a reclassification. But again and again, I repeat, only on disposal you have this problem. So how do you learn it? Top 2 digits. First, you learn OCI got 5 items. The top 2 digits needs reclassification. And what's reclassification? On disposal, don't forget, you have to close up the reserve in SOC, transfer it out to the SOPL through the OCI. You must write that in the exam. But the extreme 2 standard, 16 and IFRS 9, we transfer it to RE. What is that? On disposal, just move up, take it out from one reserve, move it to RE. It doesn't go to SOPL. So which standard permits that? 16 and IFRS 9, the extreme 2. Man, how about IS 19? I show you. See, huh? Can you see IS 19 remeasurement gain or loss? This is the odd one out, Radia. This remeasurement gain or loss is the odd one out. So I just briefly tell you what it is. You're going to learn it in detail 19, but practice when we run pension schemes. But actuaries can also go wrong. So every year they come and remeasure this. When they remeasure for gain or loss, you see. If I put that into SOPL, it will distort profits. So IASB says it's logical to put in OCI so that EPS is not affected. But take that and directly put it in RE. Can you see here? So there's no need to transfer to RE. There's no need to do a reclassification, neither. That's why 19 is the odd one out. So again and again, I'm telling you, how do you remember this? Top 2 digits. Top 2 digits, 21 and 39. Cash flow hedge and forex. Reclassification adjustment. Extreme 2. Transfer to RE. But this only happens on disposal. And what about IAS 19? Directly goes to RE. Are you with me? Did you understand the two terminologies here? What is a reclassification? What is a transfer to RE? Okay, now look at this format. Tell me if you understand. So IAS 16, IFRS 9, 1928, you don't bother lah. These three items, can you see here, will not be reclassified. So I always tell my student, just learn like this lah, which goes under reclassification, 21 and IFRS 9. So you just remember it as IAS 39 lah. So you will remember top two digits need reclassification. That's why it's under this item. Under this heading called item that may be reclassified to SOP. It's not compulsory, maybe. So everything else goes under this subheading. Are you clear? Are you clear? That's correct. I thought that's correct. Okay, but don't worry, I'll teach you all the relevant bases and everything. Just understand the terminologies first. So tell me today what you've learned. What goes to SOP? You must know this format, yeah? And what goes to OCI? Don't forget, it's 5 items, but 2 subheadings. Item that will not be reclassified to SOP, may be reclassified. Maybe is the top 2 digits. Everything else is here. Faster way to remember. So that gives me OCI. But last week, what did I tell you about OCI section? You got a choice. You can present it gross, you can present it net. See the inconsistency. SOPL is only gross format. OCI, ISB said gross format also can. Gross means what? All items before tax. Tax is shown as a separate line. You can see that. All items before tax, tax is shown as a separate line. It is logical to use that if everything has the same tax rate, but not necessarily. Different tax jurisdiction have different rules. So if all are subjected to tax at different rates, then directly take property revaluation gain minus tax, put it here, net. IIE gain minus tax, put it net. Remeasurement minus tax, put it net. Which means if I use net, no need to have a separate item. There's no income tax. It's already after tax. So you remember, gross format also can, net format also can. Okay. Then, if I'm not wrong, last week I did teach you what is the SOC. I told you the cumulative statement. What does it do? It starts with the opening balance, but we could have made errors last year. So you're going to learn that in IAS 8. If we make a mistake last year, where to correct it? Think logically, Lydia. Last year, I already submitted my financial statement with ROC. I can't go and take it back and correct it, obviously. So what must I do? Last year's RE is wrong. See, last year's this RE. Can you see this RE is wrong? So I will correct this in the SOCE by showing it as a correction of error, and I will come up with the corrected balance, means the restated balance. Right? So tomorrow or maybe next week when I teach you IAS 8, when I ask you, hey, where do we show prior adjustments? The word itself you should know, prior year. So I must correct the prior year RE, SOCE. So I take the wrong opening RE, make adjustments, and get the corrected balance. And Manan, this statement brings together two things. I explained this last week. Owner and non-owner movement. So what is owner movement? Remember this rule. If there are transactions between entity and owner, means like dividend, raising of capital, repayment of capital, share-based payments, or owner to owner, that means I'm a parent. Say I have 80% as subsidiary, means NCI is 20. But I sell off 10%. What will happen? From 80, mine will reduce to 70. NCI will go up 20 to 30. That's an owner movement. So these owner movement, reply here, where is the only place, only statement we are permitted to show owner movement in equity? That's correct. So even if your finance director says, hey, this year revenue is very low, we have raised capital, put it under revenue, should you be doing it? What will you explain? That IAS 1 says owner movement in equity can only be recognized to the SOCE. It should not be taken to the SOPL. This is deliberately being manipulated. Then we talk about the ethical implication. Okay. So that is clear. And then opening, correction, restated, owner movement. What else comes here, dear? Anybody? What is this non-owner movement? Last week I showed you this. It's a duplication. What goes vertical here? Vertical here. Goes horizontal here. I remember I took a photo of my IAS 1 format and sent it to you on the WhatsApp group chat. Am I right? Hello? Yeah, so you already have it. Yeah, no need to worry. I continue, okay? So that is it. You have opening, correction. So if I ask you, hey, which statement brings together owner and non-owner? It is the SOC. Owner, we can present line by line. Non-owner in a single line. Why single line? Because you already put it line by line here. Okay, and last, of course, this year's closing becomes next year's opening. All that you understand. Same repeat. And I've already taught you what is transferred to RE. So, man, where do the closing balances go to? You should know. See, OSC, go to OSC. RE, go to RE. And every other reserve goes to other component of equity. So what I was supposed to start this week is the balance sheet, right? I mean, of course, you've also seen two terminologies now, reclassification adjustment and transfer to RE. So now I'm going to explain the balance sheet to you very quickly. And we're going to read the definitions. After we read the definition, we're going to do case study questions to understand how IAS 1 will be examined, right? Frankly, Lydia, there can never be SBR without IAS 1. This is the very foundation. And this is where everything is being manipulated. So of course, should you know the positioning of each item? Yes, definitely, right? So now we are coming to this. I repeat, SOPL, OCI, current year, SOC cumulative with a linking statement actually. It links these two. And SOFP. So I'm going to explain that. Are you all okay? Hello? Are you all okay? All right. Come. Let me talk about the SOFP. I'm going to introduce something very important. I would appreciate it if you write it down. Yeah. Everybody knows SOFP as at means it's only at a point of time. So it's a static statement, meaning it doesn't evolve. Today, once I prepare the balance sheet, tomorrow my business continues. Balance sheet is outdated already. As at. But what does this statement show? It shows my financial position, my company's financial position. And what do you mean by that? If you read IAS 1, it shows assets, equity, liability. So when I teach you the CF, you know what CF calls this? It says this asset shows the economic resource of the company and shows the strength of the company. Okay, CF calls this economic resource. Dear, once I teach you all this, in future when I teach the CF, I won't sit and teach you all this again. Once I mention it, you should understand. So IAS 1 calls it asset, CF calls it economic resource and say, hey, that's the strength of the company. Okay, IAS 1 calls it equity, CF also calls it equity, no change. IAS 1 calls it liability, CF also calls it liability, focusing on the word obligation and says this shows the weakness of the company. But you know what CF also said? CF says these two are claims. Claim by the owner is equity. Claims by third party is liability. So look at the understanding of it. What does the balance sheet show? Financial position. IAS 1 just calls it asset, equity, liability, but CF says, hold on, why did we come up with this? Asset will show the economic resource, the strength. Equity, liability. Equity is still the same, but liability is defined as an obligation. And CF says, hold on, what is the purpose of doing this equity, liability? To understand what are the claims by the owners and what are the claims by the third party. So, putting this forward, IAS 1 further, look at this. This is where the problem comes, Ladia. SBR, every topic is interconnected. Menon, what's the definition of asset, equity, and liability? That's not here, that's in the CF. So, literally speaking, how do we learn what is an asset, what is a liability, what is equity? Hold on, that's tomorrow's class. That's the CF. You see, Ladia, this is the problem, you know. Sorry, I have to mention this. Technically, you must learn F3, move up to F7, and then come to SBR, which means you already learned all this in F7, you know. But now, this is the view I am taking. I'm taking a top-down approach. This is what Menon has to do. She has to cover everything. That's why I have to give you an overview in IAS 1. I can't go bottom up. I can't take this approach. That will take me forever. That'll take me a good 1.5 years to cover. I have no time. You should know all this. So that is why you get the overview. Menon puts CF inside IAS 1, inside IAS 10, inside. Why is she doing this? Because you're supposed to know everything. Only if you know everything, I can get into the SBR syllabus. So be patient. Menon, what is asset? What is equity? What is liability? Tomorrow, CF will teach you this. But what did IAS 1 say? IAS 1 doesn't define asset, liability, equity. It just says refer the CF. But IAS 1 says, based upon the time period, IAS 1 simply looks at, that's all, time period. It says, hey, are you planning to hold this asset more than 1 year? More than 12 months? Non-current. You want to realize it within 12 months? Current. Are you holding this liability and you are liable to pay it back beyond 12 months from the DOR? Very important, that's from the DOR, means year end. Date of reporting, okay? Then it's NCL. Is it short term? Is it something you have to pay within 12 months? Current. Man, what's the big deal? I need to learn this. I'll tell you. You get case study questions. Okay, you get case study questions. If the company has liquidity problems, what is liquidity? Current asset by current liability. That's a ratio, CA by CI. Let's say they're having cash flow problem. The intention is to push up CA and push down CF. You know what the director will tell you? Hey, certain current liability, move it, put it under NCL. Certain non-current asset, move it, put it under CA. Do you understand what you're learning this for? Or for example, gearing very high, director may tell you, hey, take up some long-term loan, put it under CL. Hello? Do you know what's the purpose you're learning this? Not just memorize the definition, NCL, CL, NCL, CL, NCA. Miss, even in F3, I studied that, correct. SBR, you must know, hey, what's the area of manipulation? Why he's asking me to move from here to here? What's the motive behind it? Am I going by the standard? Am I manipulating financial statements? Hello? Do you know what you're learning this for? Hello? So very, very important. Now, green color, all the green color. Sure, you must learn. Speak there. Sure, you must learn. Definition of CL, definition of NCL. That green color ladder is in IAS 1. But if you ask me, man, where's the definition for asset, equity, liability? That's in the CL. Why? IAS 1 simply borrowed everything from the CL. Not only IAS 1, every other standard borrows the basics from the CL. I already explained that to you. But many students will learn this. Okay, I understand now why we're learning IAS 1. But they fail to realize something. As the topic moves on, as your syllabus move on, weird thing is, many standards will then mention financial asset, non-financial asset. Look at the classification, No more NCA, no. Financial liability, non-financial liability. Ayo, man, it's so confusing. Why can't all the standards use the same word? No, they don't. So look at this. Definition, asset, equity, liability from the CI. Distinction based on time period, more than 12 months, less than 12 months, IAS 1. Teaches us the definition of NCA, CA, NCL, and CI. And equity also actually. When equity definition is here. Hey, sorry, green color. Equity. But after the students study IAS 1, okay, they figure out what is NCA, CA already. But when they start learning future standards, right, the weird part is the future standards don't mention NCA, CA much. In fact, hardly. Man, why is that? See, IASB says an asset can be NCA or CA, just depend on the time period. Nothing much to teach. You check within 12 months, CA. More than 12 months, NCA. So when you learn future standards, they don't categorize things into NCA and CA. They start using terminologies called financial and non-financial. So I have to first teach you that. What's a financial asset? What's a non-financial asset? So I have to move on. Okay? Yeah, are you aware of what I'm doing? So many terminologies in different standards. Now, I'm going to start off by the introduction of a topic that most of my students don't like, but I love this topic. Yeah, it's excellent. You learn so much here. Financial instruments governed by IAS 32, governed by IFRS 9. Don't panic. I'm just only introducing it. First word I tell my student, instrument means contract. Okay, the lawyer draws a contract. Okay, the lawyer draws a contract. So what happens? Let's say Menon Limited. Menon Limited wants to raise finance. Okay. So what does she do? She issues, means sells financial instrument. Menon, what did you sell? Well, that depends. If I sell an ordinary share capital as compared to a bond or a debenture, you see, think of the CF. Hey, that is claim by owner. That is a claim by third party. So how will Menon classify this as? In Menon's book, she calls this equity. She calls this liability. Liability. So issuer books, equity, liability. But what I sell, somebody must buy, huh? Sure enough, somebody must buy. Let's say you people, out of you buy the instruments. Okay, who are you? Investor. See the difference? You are an investor here. I am an issuer here. What did I do? I sell. What did you do? You buy. What did you buy? Man, I bought financial instruments. Correct. But what you buy is an asset for you. Now the standard says, when we both, listen carefully, huh? When we both sign a contract, see, I sell something, you buy something. I sell something, you buy something. So for me, if it is a claim by an owner, equity, claim by a third party, liability. So what is it for you? It's just an asset, lah. But when I sell equity, you buy equity. You buy equity. You cannot call it equity. You cannot, because I already call it equity. So when you buy, what is it for you? It's an IIE, investment in equity. Can you see the contract creates two instruments in two books? One guy's equity, the other guy's IIE. Now observe, one guy's financial liability is the other guy's, financial asset. What created that word financial? Anybody? What created that word financial? The contract that we signed. This is why students must always remember, no contract, no financial instrument. Very basic rule. No contract, no financial instrument. The minute the lawyer prepares a contract, two of us sign on it. What did I sell? I sell equity, you buy equity. My equity, your IIE. I sell bond or debentures. When I sell financial liability, that's your IID. Very good. Now come back and tell me. Financial asset can only be what or what? Hello? Financial asset can only be what or what? Hello? I give up. Hold on. Don't type, huh? Hold on. GN is correct. Hui Yuan, you said financial asset is only IIE. What about this? Yi Huan, big mistake. Who calls it bond? Who calls it equity? These are called fundamental errors. Sorry to say this now. Sometimes students will pass just like 51, 52. Some students fail 49. You know how frustrating and sad it is at that point. They'll always come and ask me, Menon, why they never give me 1 mark, Menon? You know what the examiner says? If you make a fundamental error, you're not ready to pass the paper. That's the deciding factor for them. That 49, 50. You understand the standards, but you don't understand the fundamentals. Yi Huan, who calls it bond or debt? Who calls it bond or debt? Please reply, dear. Don't feel shy. My job is to correct you all. Come on. No, Yi Huan, whose books? You're talking about whose books, dear? Bond or debt is whose books? Menon was asking you whose books. I asked you, what are the only? That's right. You see, these are called fundamental errors. Now, can all of you please reply? What are the only financial assets you have? Reply. Quickly type it out. What are the only financial assets? That's right. IIE, IID. So now, come back here. Wait, is that Ladia? Come back here. Do you all understand? IIE, IID, and of course, the obligation by contract. Okay, tell me. This financial asset can be what or what? Hello, this financial asset can be what or what? If you tell me, IID maturity 8 months, where will you put it? Reply quickly here. IID maturity 8 months, where will you put it? Yo, one word. Very good. Yeah, how can you say or and? Come on. Very good. If I say, hey, I borrow money for 3 months, debt, 3 months, government bonds. That means here I'm an issuer. Here I'm an investor. Do you understand the difference? Hello? Do you understand the difference? Now let me ask you a question. Quickly reply. Provision for dismantling cost. Tell me, what is it first? Asset or liability? Provision for dismantling cost. Very good. Where? Financial or non-financial? Choose. Financial or non-financial? How did you know that? How did you know that? Very good. Excellent. Brilliant. No contract. So I would write here provision for dismantling. But Menon, where to put it in our balance sheet IS1? Check la. You need to dismantle 10 years later. Why, Hari Selva? 10 years later. That is, yeah, it's okay. That's right. Very good. I'm very happy you learned that clearly. Okay, great. We're doing fine. So now, Menon, what goes under NCA? Okay, we're going to go one by one. You've understood already, huh? That means the chronology of events. CF defines asset liability equity. IS1 breaks it up into NCA, CA depending on time period. But all future standard gives us different rules depending whether it's financial or non-financial. But the student must understand financial, non-financial can be falling within NCA, CA. Very good. Now, Menon, we are only studying IS1, correct? Yeah, that's all we are studying right now. So asset, NCA, CA. Okay. First, let's look at the definition. All of you know, supposed to realize within 12 months. That is a basic definition. Everybody will know, but that's not enough. Standard says anything that can be realized within the ordinary activities includes cash and cash equivalent. Means, what do you mean by this? Okay, I'm going to give you an example. Think and answer, okay? Menon is a construction company. Okay, so normally, as I finish my job, I give my customers 3 months credit. They must pay me within 3 months. Or Menon is a trading company. She sells goods and services. Customer must pay me within 3 months. Who are the customer? Receivables, right? Receivables. So if I tell you within 3 months, everybody knows it's current asset. Means customer, receivable, sold on credit. Everybody knows this. But listen carefully. I'm a construction company, and usually I give, it's a multi-billion-dollar project. So usually I give my customer 9 months credit, 9 months credit. But because of this pandemic, I have realized that it's difficult for my customer to pay me within 9 months, and I voluntarily extend the credit period to 15 months. So up to last year, 9 months, current asset. This year, I extended my credit period to 15 months. Current or non-current? Current or non-current? Receivables. Look, that's wrong. Huion is correct. Look to the border. Now you'll understand, man, why we need to learn this definition. Many students, they just memorize definition without even knowing what you're learning it for. But from the way I teach, you should realize everything I keep throwing examples at you, because that's case study for you. You know what the standard says here? As long as the receivable is part of ordinary activities, even if it extends beyond 12 months, it is still a current asset. Did you understand the definition? That means it must be part of ordinary activities. So even if it exceeds, means part of normal operating cycle, we call it part of ordinary activity. That's my business. So in such cases, even if it exceeds 12 months, still only a what? Hello, still only a what? That's right, current asset, okay? So you'll understand now. Cash and cash equivalent, of course, all of you know, cash in hand, cash at bank. Cash equivalents are any securities that can be quickly converted into cash. There's an active market, anytime I want, I can convert it to liquid cash. Easily, I can find a buyer. Okay, so that's the definition. So, man, what goes under NCA? Oh, well, easy definition. Anything other than CA. Nice luck. So, actually, definition is only CA you have to learn. Anything other than that is NCA. Man, I need to see the definition. Don't panic. It's all there in your book. Relax. Just study first, then I run to the book. Okay? NCA, we have PPE, which is tangible. Intangible, we have goodwill, other intangibles. Then we are misrepresenting because we won't realize, wouldn't this affect the going concern as well? Okay, two different issues, Hari Selva. Number one, miss, it's collectible beyond 12 months, but you are still putting it under current asset. Would it be misleading? Now tell me, I taught you this before. Part of operating cycle, I want the primary user to know it's actually my normal trade receivable. So I put it under current asset. Now you're worried that it would mislead the primary user. What should you do? Hari Selva, I did this last week. Do you believe it will affect decision making? Can the rest of you also participate? It's a very good question. Why? I'm not willing to take that for an answer. It affects decision making. Excellent. That's the correct answer. So, Menon, if I put it under current asset, it could mislead them. So it's material, idea. Material means, what must you say? If it affects decision making, it is material, then you will appropriately disclose this in the notes to accounts. Now the next question you ask me, Hari, would it affect going concern? So let's say customers are not paying me, I'm unable to meet my debt obligation. See, these things, this information must be given in the question. We cannot go outside of the question and imagine things. But let's say in the case study, the examiner continues and say, because collection is not possible right now, but obligations, we have not got any loan moratoriums, we are unable to meet our debt. So there's a liquidity problem, giving rise to the question whether the company can be in existence. Then yes, you must disclose that going concern may not apply. Okay, and then you must say, what are you preparing your financial statements based on breakup value? You got it here, Hari? Okay, so I continue. Good question, but I'm going to continue. Now look here, PPE tangible. I'm doing non-current asset, tangible, intangible. Those of you who watch the video on IS 38, I'm going to ask you a question. Please reply. So that was the video on IS 16. That was the video on 38. Does IS 38 cover goodwill within its scope? Does IS 38 cover goodwill within its scope? Hello, silence. Hey, are you here with me? 100 of you does IS 38 cover goodwill within its scope? You know what we call this as the blind leading the blind. One student say yes, everybody says yes. Okay, I am completely disappointed. So effective this week, every week that I tell you to watch a video and you don't watch it, I will close access to that video the very next week. You heard me? You heard me? You're pushing me to do this because you did not do what I asked you to do. So every video, you'll only have 1 week access. I'm going to close this. Okay, because you don't study, you're forcing me to do this. End of this Sunday, I will close access to all the 4 videos. I mean that. IS 38 covers all other intangible. Look at this word. Other intangible, other than goodwill. Goodwill falls within the scope of IFRS 3. What a major mistake you'll make. That's the first thing I would have started in the video. That tells me you haven't watched it. I'll tell you something. I can show you all the past year questions. You will never see one SBR exam without IS 38. Not one. Every semester IS 38 is examined. Shall I close the video? I'm talking to you. So will you finish it? Never mind. I understand you're working people. You're very busy. No issues. Tonight you finish IS 38. Tomorrow I will ask you questions. Okay? I trust you will do that. Is that okay? Tonight you finish IS 38. Tomorrow I'll ask you questions. Right? Leave it. Okay, never mind. Don't worry about it. Let's move on. So goodwill falls within the scope of IFRS 3. How are you going to differentiate? You watch the video, right? All details are there. So tangible, intangible. Now tell me, dear. Financial asset, IIE, IIB. And you have biological assets. That's IS 41. Living animals and plants. So can you see non-current got tangible, intangible, financial, biological assets. Are you all clear? Look at this. Asset, NCA, CA. Here you have to learn the definition of what goes under CA. So you got inventory, receivable, other current asset, cash and cash equivalent. Then non-current, PPE. Can you see why goodwill is always a separate line item? Because that is governed by IFRS 3. That is governed by IS 38. 38 covers all other intangibles other than goodwill. Then investment associate, leave it like group accounts. Then you got financial asset. So we have finished asset category. Now come to equity. Now come to equity. Observe these 2 words. Equity attributable to owners of parent and NCI. Now, I'm going to explain something. Claims by, hello? Claims by who, dear? That's right. Who are the owners? So let's say that we have a subsidiary company. Subsidiary company issues equity. Equity means ordinary shares. Let's say parent by 80%, NCI by 20%. So let's say, for convenience sake, 200 shares, 160 shares, 40 shares. Now these people, this third party that holds the 40 ordinary share are called NCI. And what's the big deal? So I repeat again, what is equity? Claims by owner. Who are the owner, parent, and NCI? What must they hold? Equity. Very important. So when a third party holds equity in a subsidiary, we call them NCI. And what's the big deal? What is it you're trying to say? Let's say subsidiary issues debentures, bonds. Okay? And I tell you, 80% held by Menon, 20% held by you. Okay? Now, who is Menon and who is you? These are claims, but not as an owner. Okay? Not as an owner. So when Menon buys the bonds, you buy the bond. Okay, we are both invested up, but we're not doing investor books. My question is, who are you in the books of the issuer? Both Menon and you are claims from third party, and hence NCL, NCL. This third party, I can't call them NCI. I can't call Menon owner. I cannot call Menon parent. So this is so often tested. You won't believe it, you know. They will tell you third party, Yes, creditors, that's correct. Liability law. So, Menon, what's the big deal, Ladia? See, I show you. Case study, you know what came up? Company has very high gearing now. Okay, there's this company, gearing is very high. So, can you see this long-term borrowing? So, let's say fully from third party, Ladia. Fully. Menon never buy anything. Fully from third party. You know what the director will say? Take the third party claims and put it under NCI. Why? He wants to move this borrowing to equity because NCI is part of equity, see? Manipulation. So, this standard IS1 is so clear. Who is NCI? Who is NCI? They are third parties who hold what shares? Hello? Very important. not ordinary, equity shares. One example is OSC in the subsidiary. Are you writing it down very clearly? See, everything I teach you, what's the purpose of learning this? Everything boils down to manipulation. If you wrongly present it in your financial statement, lot of ratios are affected. It will mislead the primary user. It could be intentional, it could be otherwise. This is what examiner is testing. But if the third party who holds bond or debentures in S, this fellow, sorry la, see, this guy is called NCI, but this guy is just called creditors and must appear under NCL in the balance sheet. Got it? Got it here? So now you learned equity part. Manan, what is the definition for equity? Equity definition very easy la. Take all the asset minus liability. Equity definition is residual. Means take all the assets of the company, pay off the claims by third party. Only if there is any balance left, it belongs to owners. Means claims by owner. We always, Companies Act, I'm sure you've learned. In Companies Act, the last in the category of liquidation. Sell off all your assets, pay off all the claims by third party. Only if anything is left, we can pay to owners. They are the risk takers of the company. So when I ask you what is equity, just remember the word residual. Man, and residual of what? There. So easy. Many ways you can understand. What is equity? We take the total of asset minus the total of liability gives me equity. Simple. Or what is another way you can define equity? Equity is all the capital plus reserve, including NCI. Capital plus reserve. Man, where does this come from? There. Capital. RE. All reserves here come from OCE. Only difference is, can you see this line here? This side is all parent. This side is what belongs to NCI. Put them together is equity. It's up to you. Remember it as residual, A minus L. Or you can remember it as capital plus reserve of parent, including NCI. But be careful. Who is NCI? They are third parties holding ordinary shares in the subsidiary. Equity. Third party hold debentures in the subsidiary. Sorry, that's NCI. We call them creditors. Are you with me? Last part we have is liabilities. Okay, that you know. Liability got two parts, non-current, current. So the definition that you will learn is what is a current liability. So that's the last part in your book. Let me take you there. Okay, go back to IS 1, all of you. I was doing this last week. So I'll continue. I won't sit and read the whole standard video. I already told you that. Okay, this is what we finished. I've done all this last week. The principles, materiality, PS2, everything was done. And I was looking at assets. Now you know that. So assets got tangible, intangible, investments which are financial assets, biological assets. I've left it out. All this is done already last week. But Menon, what is the definition of current asset? This you must memorize. This is the one I was explaining. See, you must memorize this. An entity shall classify an asset as current asset if it expects to realize, intends to sell it in the normal operating cycle. What did I tell you? Normal operating cycle, even when they are not expected to be realized within 12 months. Make sure you memorize this. Anything that is held for trading means I buy and sell. Anything that I intend to realize within 12 months or cash and cash equivalent. Non-current is anything other than that. Classification, tangible, intangible, financial, biological. So what I'm left with is liabilities. Are you here with me? Hello? Come. Let's look at liability definition. You're free to write with me. Okay, tell me. Entity shall classify liability as current when it expects to settle the liability within its normal operating cycle. Read note 1. Normal operating cycle, even if it is due to be settled above 12 months, as long as it is part of normal operating cycle. But as what Harry said, if it's misleading, material, disclose it. Are we clear? Dear, you must memorize this. Hello? Hello? Next, held for trading. Of course, every time buy and sell short term. Normally, it is to be settled within 12 months, but emphasis is on part B. If I'm not mistaken, I did this last week. Am I right? Hello? I'm waiting for a reply. Have I done it or not yet done it? I think this part I didn't do. Let me finish it. Anyway, we're almost done. Last part. To explain part D, read that carefully. When can we say a liability is current? I repeat, you must memorize this. An entity will show a liability as current when it does not have an unconditional right to defer the settlement of the liability for at least 12 months after the reporting period. That means I don't have the right to postpone it. I have to settle it. I have to pay it. Come, I'll give you examples. You answer my question, huh? Keep answering here. Okay, I'm going to write the questions here. You keep answering here. So tell me, let's say original loan that Menon took is a 5-year loan. Year 1, 2, 3, 4, 5. So she borrowed 100 and she will repay 100 here. Okay, she'll repay 100 here. In between got interest, but ignore the interest. Principal sum. Tell me, end of year 1, how many more years to go there? 4. End of year 2, how many years to go? 3. That's right. End of year 3, 2 more years to go. So tell me, year 1, 2, 3, 4, 5. The loan payable. NCL, because in 4 years time. NCL in 3 years time. NCL in 2 years time. Correct? Now think and answer. At the 4th year, where will I present my liability? I have to pay it within, yes, I have to pay it within 12 months. 1. If Menon does not have an unconditional right to defer payment beyond 12 months from the DOR, of course. That means that, dear, I have no choice. I have to pay it within 12 months. I do not have an unconditional right to defer. Your answer is correct, current liability. But let's say I extend the case study and I say, hey, this loaner is taken from parent company. Okay. Subsidiary already met the directors of the parent company before the DOR, before the year end. So Menon company already met the directors of the parent company before the DOR, and we have agreed that subsidiary, that's me, can differ indefinitely because it's a related party loan. Now answer my question, current or non-current? Very good. Yes, you see, wait. You see, all of you are giving me you remember I said QIC principle? All of you are giving me the conclusion. I will give you no marks in your exam, but I will give full mark to Zaino because he gave me the reason. This is what in SBR exam you must be very careful. Students will always jump to write the conclusion. No, the conclusion is not what carries marks. It's the inference. That means in exam you must say, since Menon has already negotiated with the lender before the DOR and has agreed, lender has agreed, Menon has an unconditional right to defer. Menon has that right to defer. Therefore, Menon will continue to show it as a NCL. Got it? Got it? Next, you see how I change, huh? Let's say Menon went and met these people, but just after the DOR, not before the DOR. She went and met after the DOR and they've agreed. Now think carefully and answer. At the DOR, was it repayable on demand? At the DOR, was it repayable on demand? Means should I have met it within 12 months? Current or non-current? Reason. Tell me, how will I present it? I negotiated, but it so happened I negotiated after the DOR. So at the DOR, when you prepare balance sheet, NCL or CL? Tell me two things I want, reason, NCL or CL? Very good. At the DOR, I haven't met them yet. So Menon did not have an unconditional right to defer payment. Menon should have shown it as a, wait, some of you are wrong. Hey, I only negotiated after the year end, Ladia. At the DOR, I did not have an unconditional right. That's correct. Now, that continues to IAS 10. Adjusting, non-adjusting even. That's this weekend video for you all to watch. Or rather this whole week's video to watch. You already got one pending today. So please finish IAS 38 today. Tomorrow, if I ask questions and you don't reply, I will really close the video. Okay? I mean that. I'm sorry I have to push you to this extent because time is very short. Okay? So that's clear. But I changed my story now. I tell you something like this. Menon took a 5-year loan, $100. But agreement is she will pay it in installments of 5 lakhs over 5 years. She'll pay it in installments over 5 years. See the difference? Earlier example was lump sum. This is installment. So Menon, what's your outstanding liability? Of course, 80, 60, 40, 20 nil. Now my question is, of course it's a liability. We understand that. Menon took a loan. Where should you present it? NCL or CL or both? That's correct. See, what is the hint for you? Student always ask me, now I know whether I want to split. This word, installment is the key word. Total I owe 80, but within 12 months I must pay how much there? Within 12 months. Very good, Zainul. That's right. Very good. 20 here, 60 here. Agree? Next year, 60. Within 12 months, 20, 40, more than that, 12. NCL. 40, 20, 20. 20 and nil. Got it? Got it? So that is in the book here. Okay, that's the green part. You can see. Have I done this? No, right? Have I done it or not? Hello? Come, write it down. Do whatever you want. Come. Never mind. No problem. Right. It's all there. Have you finished this part? Hello? Have you finished this in the book? It's all in the book, Ladia. Nothing to do. Come, write it down. This one. So the key to remember is the word installments. Okay, after this, I'm going to stop. We're going to take a break. Finish breakfast. Come back. I want to do some case study questions. Okay? Come, finish writing it quickly. Are we done? Then when you finish, you tell me there's nothing much for you to write. Just highlighting. Can I move on? Now, this exception is very important. Read this. When a company breaches a contract, so let's say I took a 5-year loan. Now, because of the pandemic, I couldn't pay. So when I breach a contract, and very important, it becomes repayable on demand. That means our agreement is, if I fail to meet the payment, the bank can immediately demand. Then look at this word here. Must classify it as a current liability. Underline these 3 words. Breach a contract, repayable on demand. I must show it as current liability. But immediately student must link it. If the bank forced me to pay, I might not be able to continue as a going concern. So you see what I've written here. Appropriate disclosure must be done for going concern. Okay. So I breach a contract, becomes repayable on demand. I must show it as a current liability. Why? Because I do not have an unconditional right to defer the payment. Okay. That's just examples. Yeah. But when we negotiated with the lender agrees already. But when did I negotiate? That's very important. Negotiations happened before the year end. No problem. Negotiated before the year end. I've got an unconditional right to defer. It's NCL. Once you finish, you tell me, huh? Come, write the next part. But if negotiation happened after the year end, too bad lah. At the year end, it is still repayable on demand. Yeah, then I have no choice. I have to present it as a current liability. Got it? Ayo, why like that? Hold on, let me move it down. Now, 5-year loan. I'm just giving you all the examples I put is in the book. So original loan 5 years, I would have shown it as NCL for 3 years, except the last but 1 year, I have to move it down to current liability, because if I've not yet negotiated, I cannot roll it over, then it's a current liability. But if you say, oh man, related party already negotiated before the year end, NCL. Are we clear? Come, move on to equity. What are the definitions I told you? Make sure you learn this. Nothing left to memorize, huh? It's all there. Equity is net asset, which is nothing but residual value. What is residual? We take asset minus liability. Alternatively, you see, the word equity got different names. Residual is because asset minus liability. Asset minus liability, UK calls it net asset. Another way to describe it is capital plus reserve. But what did I teach you? Capital plus reserve right there. Owned by, oops. By who and who here? Parent and NCI. Are we clear? Okay. So, Menon, what are the type of reserves we can have? Please read this. All very fundamental. F3, basic CAT, you will learn. Capital reserves are compulsory to be created by law. Revenue reserves are from profits of the company. Revenue available for distribution. Capital is not available for distribution. So here, please write down what I'm writing. Subsidiary company, 100 ordinary shares. Subsidiary company, 100 debentures. Here, H holds 80%, 80 shares. Third party holds 20%, 20 shares. But here, H holds 70%. Third party holds 30%. So that's 30 debentures or 30 bonds, 70 bonds. What is the status of these people? This fellow is called parent. This third party, because they hold ordinary shares, equity, is called NCI. But when we just hold bonds, you and me, both of us, are just called creditors of the company. Are you clear? Are you clear? Can I move on? Can I move on? Okay, that's it. We stop here. Later when I come back, please sit ready with the workbook.